Part of our initial presentation when we started doing these webcasts was talking about market inelasticity and how these distortions start to become a self-fulfilling prophecy until they're not. And one of the one of the interviews that you gave fairly recently talked about how through the 90s that a dollar into the market generally represented a 1 cent change in the underlying price. And now we see these distortions. Sometimes a dollar could represent as much as $5 to $17. And my question for you was, um, one, how are we thinking through those calculations? Two is, um, in the case of, in the case, your life's work has been passive flows, and and one
That
of
is not
that's not
true.
to
But anyway, go ahead.
you know what that's not to or rather that's what you're most known for, I should say. I'm sorry, I don't
Yes,
mean
that's
to
fine.
diminish your work, but one of the one of the statistics that you've mentioned of the last sort of month that really sprung to mind was the Vanguard Total Asset Fund with 1.6 trillion under management has liquidity of about 80 million, and the Fidelity contra fund with maybe the largest active managed fund in the world has 100 billion under management, and they're 2.5% liquidity in their book. So I just wanted to sort of gauge your reaction on what those two things mean to you. And obviously, it hasn't happened historically where we've actually seen a massive redemption from target dates, etc. But it's an interesting discussion to think about, what has perpetuated this inelasticity further and what it would look like for you should things decide to go the other way.
Sure. So first, just to orient people to the terms that we're using here, right? So inelasticity is an economic term measuring how sensitive supply and demand are to changes in price, or more accurately, how much price can change in response to a small change in supply or demand. If something is inelastic, it means that it changes quite a bit, or it can change quite a bit in price without supply or demand being affected. If something is highly elastic, it means, ironically, that your demand falls significantly for an increase in price, right? Really simple examples would be things like gasoline, relatively inelastic over short periods of time. You pull into the your car is on empty. You pull into the sole highway gas station that's within 100 miles, and they will basically be able to charge you whatever they want. On the flip side of that, a highly elastic market is one that is extremely competitive, and you're used to seeing this type of dynamic. If you go to a mall location where you can shop in multiple stores, you're very free to comparison shop across, right? And so your demand will collapse to zero if there's, let's use actually the gas station, let's extend it. If there's four gas stations on the four corners of the intersection, we've all seen this example, right? And there's one that has 5 cents above. Notably, there's going to be nobody in that gas station, right? Effectively, demand collapses to zero because of the price change. Um, that's what we're talking about when we talk about the inelasticity of the market. And there's been an incredible amount of research, both academic and empirical, in the past several years that has challenged the idea that markets are highly competitive, that markets are highly elastic. In other words, they can absorb large changes in supply and demand with relatively small changes in price. Um, it's that theory of markets as being highly elastic that actually led to the entire theory of passive investing not being that big of a deal, right? If we're all reacting to information, none of us can be that highly confident in the impact of our information. And as a result, the markets are actually very capable of absorbing significant inflows and outflows with very minor changes in price, because theoretically it's tied to some fundamental value. And almost all of the research has been basically trying to figure out why, if that's true, why the heck are markets so volatile, right? They're much more volatile than they actually should be under that framework. So it turns out starting in about 2017 and then specifically in 2020, a bunch of academics really began to develop the tools and techniques to measure this stuff. It's referred to as Gabayan Koijen's, the inelastic market hypothesis. And that kind of sits at the core of a lot of the flow-based dynamics that we spend a lot of our time talking about. So if that hypothesis, and I remind people that we're using this in the scientific method standpoint, hypothesis means it stands and it has been demonstrated, but until something better comes along, we basically treat it as, true, constantly challenging it, right? It's not that it's just a random conjecture that's been thrown out there. When you start thinking about a lot of the dynamics that we talk about at Tier 1, things like hedging flows, right? The dealers have to react to this. That's why we have a high degree of confidence that they're actually influencing the market, because we know that their flows ultimately do matter. They work very hard to minimize that impact. We work really hard to try to figure out, where are they having that impact, right? Okay, so all of that brings us back to the question that David asked me, which is this difference between, say, how Vanguard's funds behave and how an actively managed fund behaves. And so let me just actually share my screen here to show this. And I apologize. I'm actually in New York City traveling today. So let's take a look here. When we look at the holdings of something like the Vanguard Total Stock Market Index, you're going to see that it has, all the traditional components that you would expect in the S&P 500. It basically has the S&P 500 at the top of it. So Apple, Microsoft, Amazon, Nvidia, Google, etc. And it's going to have them in roughly the same proportion as the S&P 500. It's going to be slightly lower because we've added on roughly another 10% of the stocks outstanding. You'll notice how concentrated it is in the lower right-hand corner, the percent top 10. And then if you scroll down, I think we'll be able to see what the cash percentage is. Otherwise, you're just going to have to trust me on it. But long story short, the Vanguard product, or most index products, I'm not picking on Vanguard per se, will have somewhere between 5 to 25 basis points worth of cash. That means every time you go in to buy the Vanguard product, you are actually immediately plowing into the market. They're buying the shares in all the stocks. It's exactly what they're supposed to do. There's nothing nefarious about this. But it also means that they have no capacity to effectively wait patiently, right? So they can't hold the cash. They can't evaluate, is there a better time to trade, et cetera, et cetera. It just becomes pure feedback. It goes straight into the market. If we were to flip and we were to look at something like the Fidelity, and actually, again, just to highlight this, the assets under management here for this ETF, you can see that the $314 billion, the mutual fund itself is slightly over $1 trillion. There's various asset classes of it, et cetera. And ultimately, it has about $80 million worth of cash in it, right? Against that trillion plus, it's about 1.5 trillion across the various asset classes that it has. So if in contrast, we were to look at the Fidelity Contra Fund, right, and the ticker there is FCNTX, the holdings of that would show total value of about $100 billion, of which about 3.25 billion is actually in cash. So among their largest holdings is actually going to be cash. What that means is that when they receive a redemption notice, or when they receive a new order, when somebody buys shares in the Fidelity Contra Fund, the first stop is cash, right? And then the portfolio manager says, do I want to buy? Do I want to sell? Do I consider the valuations? Is the price run away from me, et cetera? I can choose to buy less. That means, by definition, that they're going to be less inelastic. They're going to be more elastic in their reaction function. They will react to valuations because they have a price target on it, et cetera, et cetera. So when we replace vehicles like the Fidelity Contra Fund with vehicles like the Total Market Index, we end up increasing the inelasticity of the market. And that's really what we were highlighting. And so when we start thinking about passive share getting into the 40, 50% sort of numbers, and you start thinking about the implications of either contributions or redemptions that are all effectively trying to buy the exact same stuff, right? The only thing that ends up happening is that you end up piling huge amounts of money either into stuff or being forced to take it out of it. And that's what I was referring to when I talked in that interview on this topic of inelasticity. If you run through the math, it actually works out that the elasticity or inelasticity, $1 into your traditional active mutual fund would result in roughly a $2 increase in the market cap of the security that's trying to be bought, right? Those seem like really big multipliers, but they're actually quite small because we're talking about a single fund. We're talking about the size of the order in total. So it ends up being relatively tame, although it certainly helps explain the volatility that we see in markets. When they go up, as people start adding money, they go down when people start taking money out. The problem is when you start putting them into the passive vehicles, into the indices, then that multiplier climbs, right? Part of that is simply because you don't have that cash balance. The other part of it is perversely, their model works in the opposite direction. When something goes up in price, it actually receives higher allocations, not lower allocations. And so as a result, it ends up reinforcing these dynamics quite significantly. And I think that's a key contributor to what we're seeing, right? The easiest way to think about what's just happened is we're seeing money go back into the market. We'd actually talked about the fact that active managers or investors were relatively underinvested. As they tried to buy back in, they immediately just went, okay, get me NASDAQ futures, get me the Qs, get me SPY, get me E-minis, et cetera. And as a result, an overweight order is basically going in for Apple, Microsoft, et cetera. And I really think, unfortunately, that's what we're seeing in the market today. I also think, as we hypothesize, like, it doesn't seem to be, to me, to be a coincidence at all that the market hit its low right as we were hitting the, as we were ending the window for stock buybacks from Microsoft's, Apple's, et cetera, of the world, who are buying back such absurd quantities and themselves are subject to a lot of these same dynamics, right? So when Apple puts $80 billion worth of buybacks into the market, that inelasticity of the market is actually going to play, or if Apple stock is going to play a significant role in terms of the impact that those buybacks have. And it really does seem like that this was pretty straightforward. I mean, the extraordinary divergence that's occurred in the mega caps, right? We talked about it in today's note. Apple up 7.5% since earnings, Microsoft up similarly, Amazon up 20%. Meanwhile, the Russell has given back all of the gains, almost all of the gains that it picked up in that, November 1st rally. So this has been, absolutely one of these incredibly humbling experiences where you look at this and you're just like, you just have to respect the power of these flows. Did that answer your question, David? Was that helpful?
Yeah, 100%. Thank you, Mark.